Mark. How are you?
Lex, how are you doing?
You know what today is, don't you?
Today is Thursday.
Well, yeah, it's the market shot. We're again back to the traders workshop. So we've done a series of these. I can't remember the exact number, maybe six. This will be seven. The idea, we're taking some of the concepts that we learned as floor traders and proprietary type traders and sort of introducing them to the retail community a little bit. Now, the caveat that I always like to throw out is probably not things that you actually trade. You're probably not going to trade a jelly roll as a retail trader, or you probably won't do a box. But I learned that it's a great tool to understand the dynamics of the board. When I say the board, I mean the options grid and the relationships that exist. So once I understood those relationships, it made it much easier for me to do the simpler things that we're going to talk about. Maybe one of those today, right?
Exactly. And so, I think, we've been talking a lot about the different heuristics that people use and, using the synthetics and understanding, using that as a proxy for, interest rates and understanding the relationship between sort of different pricing and interest rate dividend levels and whatnot. And so I think one of the other shortcuts that we use are butterflies.
Mm-hmm.
That a butterfly is a great way of thinking about overall relative volatility level.
Right.
And making sure your butterflies are lined up helps you kind of put together the relationship between the different months, understanding the pricing difference between butterflies. Really gives sort of that perspective on vol the way that a lot of these synthetics will give perspective on rates, dividends, carry, etc.
Sure. Exactly right. So let's do this. Let's go to a month that I don't have anything in. How's that sound? Let's go to October. Okay. And here's what I'm going to do. I'm going to set up a call butterfly first of all. Okay. Call butterflies are I shouldn't say just call butterflies, but butterflies 1 by 2. That's a $10 butterfly, right? So let's go to the 95. Okay. So I have a $10 butterfly set up there, right? And we're going to break this down and do two things with it. So first of all, I did this. I bought one, right? I sold two, and I bought one. So Mark, can you give us the dynamics of a spread like this? What things can happen good for a spread like this?
Yeah, so I think one thing that's interesting when you think about buying one, selling two, and buying one, you can also decompose that a little bit and look at it as a long call spread. You're long the 275, 285 call spread, and you're short the 285 to 95 call spread.
Right. So let me take it apart now so they can see that. So watch this. So I'm going to remove the upper strike and let's just deal with half of this, and I'm going to make this a one lot. Okay, this leg here. So what Mark just said is the butterfly consists of two spreads. It's a long call spread, which we have designed here. Okay, so we have the 1 by 1 spread here as a long call spread. Good things that can happen there. Stock goes up, but the most we can make, right, is the difference between those calls, those two strikes, less what we pay for it. And in this example, it looks like we're paying about $6.10. Okay. So far, so good?
Exactly. So you're paying $6.10 for this. Most it could be worth is $10. If it's worth $10, you've made $4 or $3.90 on the $6.10 that you
That's correct. Okay. So that's half of a butterfly. Okay. The other half of the butterfly, let's take these out, okay, for a second. And we're going to go into this 285 to 95 short call spread, right? So
correct.
This is a credit spread. The other one was a debit spread. The net of the two was a debit, in fact, okay? But this spread benefits by being beneath this 285 strike at expiration, and we collect the full extent of the credit, right? Because if we look at this, if the stock price goes way up higher, what can we lose? We can lose the difference between our strikes, which is $10, less the credit we get for it, which is $4.60 in this example. Right?
Exactly. So with this short call spread, we want spot to stay below 285.
Mm-hmm.
That's where we make the most money from that. That's where we make our $4.60.
Right.
With the other spread, the 275, 285 long call spread, we want it to be above 285. So we have sort of two competing spreads, one that's going to benefit the most from being below 285 and one that's going to benefit the most from being above 285. That leaves us with our maximum profit scenario in the butterfly of being at exactly 285.
Right. Right. Because we have
So
the good situation with the long call spread where that can go up to infinity. That would be wonderful. But we have the short call spread above it that can't go to infinity. So we have to, they're balancing each other out. And as it turns out, the happy zone, as Mark just said, is right at that price at expiration. So I'm going to add the other two legs. Remember, it was the 75, 85, and then we get back to our 1x2 butterfly again. So that graph at expiration looks wonderful at that 285 level, which is that high point on the graph right there. Agreed?
exactly correct.
Okay.
And so in this case, we are long the butterfly.
That's
Yep. We are paying to enter into the butterfly.
Yeah.
So like you mentioned before, the one spread was a debit, the one spread was a credit, and the net of those two, 610, 460, comes out to $1.50.
Yep.
Look at that.
Yep. So there it is, $1.50. And it's a debit, just to be clear. So the most we can lose on the spread is $1.50, no matter what. Up to infinity, down to zero, we can lose $1.50. The most we can make on the spread at that 285, right? So that call spread is going to be worth 10. The other one's going to go out at 0, right? So we can make difference between 10 and what we pay for this. Is that how that works?
Exactly correct. So the, in an even distance or equidistant butterfly where the legs are both $10, the max you can make is that distance between the midpoint and one of the legs minus the amount that you paid.
Right. And we'll talk in another video. We'll talk about when we can misalign these. And I think they call those, what do they call the odd?
I call them broken wing butterflies.
Broken wing, that's it. Okay, so
And,
broken wing butterfly.
As a side note, I'm a huge fan of the broken wing butterfly.
Yep.
I think it's, butterflies in general, I think are a really interesting tool in the option space. The broken wings allow you to get even more precise in terms of layering on a little bit of a direction to the trade. But
yep, perfect. We'll talk about that in another video.
Done as a, sorry, go ahead.
No, I said we'll do a whole video on a broken wing because it is an interesting trade.
Very interesting. And
yeah,
generally butterflies are set up as a relatively market neutral trade.
Right.
That it's typically a sort of volatility play.
Right.
So in this case, you're paying this debit, you're paying this $1.50, and your best case scenario is that volatility comes in and that stock settles right around that midpoint. So you're actually paying a credit to get short volatility.
That's right. That's right. Yeah, we typically do the long butterfly. We do the long butterflies though when volatility is typically higher, right? Because don't the butterflies trade a little cheaper when volatility is pretty high? Implied volatility, that is. Yeah.
Because the sort of way I think about that is almost like a distribution, right? And as vol gets higher, that distribution is going to get wider and kind of flatter. So relatively where the chance of that stock ending up and actually pinning is going to be much lower. So that inherently makes that butterfly less expensive.
Right, right. It's a great tool too. I've used butterflies my whole trading career. I'd say very effective. Let's take one more look at something here relative to this butterfly. I just want to kind of emphasize how this butterfly can building on our box information. So let's have a look at this. Remember what we did here. Okay, let me get my drawing tool out. Hold on, these go away when I stop sharing screens. So remember what we did. We have a long butterfly here. What happens if we put on the opposite on the put side, or a short butterfly? Okay, so let's think about that a second. And this is why these relationships are important. So a short butterfly is going to look something like this. Let me clear this out. And what we're going to do here is we're going to sell one of these, buy two of these, and sell one of these. This is a short butterfly. These are done for credits. The best we can do on these is make that credit. And what we need to have happen here is we need to have it go beyond these upper strikes and get away from that midpoint, right?
Exactly, because then thinking back to that whole call spread, put spread dynamic, here you are going to be long the 285, 275 put spread, max value comes when that goes far south, below 275.
Right.
You're also going to be short the 295, 285 put spread.
Right.
Your best case scenario with that is when you're above 295.
Right.
So in both of those cases, your worst case scenario is again at the middle,
Right there.
at that strike that you're long. That if Microsoft settles at that 285 come October, you're going to all of the credit that you will have received is going to evaporate, and both of these spreads will be at their max value, which is your max loss.
Right. $10, right? In this case. Yep.
Exactly.
Less the credit you did for it. So yeah, we're going to lose, what is it, 850 on this one at 285 at expiration. Okay. Now, interestingly though, if you combine this short butterfly with the exact long butterfly on the other side, what do we have? So I'm going to propose that we have a combination of two boxes. Okay, now let's watch this. What I'm going to do is I'm going to take off the upper leg. We're going to do this in pieces again. And I'll put this back to 1. So this is half of the short butterfly, okay? So we're long the 285, short the 270. Let's do the opposite over on the call side. So what happens when I'm long the 275 and short the 285? Looks awfully close to a box, isn't it? It's not awfully close, it is a box. Okay.
It absolutely is a box. And
so that's a box. That's a $10 box. Remember, $10 boxes have to be around 10 bucks. There it is, right at 10 bucks. I'm going to clear this out. Now, here's what we're going to do. We're going to do the upper ones now. So the short put side, remember, still have that same 285, and we're going to be short the 295 put. Okay. The upper side of the call one is we're short the 285 call, and we're long the 285. I'm sorry, 295 call. What does that look like? That's very familiar to a short box, right? So these two butterflies at opposite sides, you got a long box in the bottom, you got a short box on top. So it's a combination of two boxes, both $10, okay? And obviously you could do all this for an ARB, you would do it, but I guarantee you it's not out of line ever. And you won't be able to do it, but it's a learning tool to see how these options and how you can manipulate all these different spreads into other things. Okay, and when you can understand the components, you get a much better understanding of the whole compilation of what's going on in an option chain.
That's exactly right.
So,
and actually, let's take a look at the difference between, say, like an October butterfly and a November butterfly.
Okay,
the same distance.
Yep. So you want to do that same call butterfly we did here in October?
Yeah, let's do that same call butterfly.
Okay, so here I am just doing it real fast. Okay, call butterfly. So let's make it $1.50 so that the math is easy. Okay, good.
Great. So $1.50 in October for the $10 wide butterfly.
You got it. So where do you want to head for the near term?
Or we can go near, or we can go further. It doesn't matter. Maybe pick a closer expiration.
Okay, you want to go to like July 30th? That's not.
Yeah, relatively close.
Relatively close. So about 8 days away. Do we have the same numbers? We should, right?
Yeah.
Yeah. Okay. Let's do the same number. 74. Oops, let me get rid of all this. Let's do 75. We did 85 and we did 95, right?
Correct.
Okay. So remember the old one, the previous one in October was $1.50. Okay. This one is 312. Let's call it 310. I like easy math. So let's make it 310.
So it's sort of counterintuitive, right? That the nearer term butterfly is more expensive. We're used to longer term options being more expensive. That, intuitively sort of makes sense. But the way I've kind of wrapped my head around this is, with Microsoft trading 285 right now, the chances in the next 8 days of it being 285 are relatively high.
Sure.
We don't have that much time for volatility to work itself out.
Right.
If we want to go 85 days out to October, you've got a much longer time horizon. And volatility and time are opposite sides of the coin in the options pricing model.
That's right.
The more time you give volatility to work, the more distribution you're going to see in terms of potential prices.
That's right.
So on a short time frame, there's a good chance that Microsoft is going to land relatively close to 285. $3.10 is what the market's sort of pricing this thing that could have a max value of 10.
Right.
Now, give it a lot more time, give it 10 times as many days, and the market's pricing that at less than half of that chance.
That's right.
Just because of the time, the effects that time have to allow volatility to manifest itself.
Yep, exactly right. Exactly right. And I've heard some teachers and educators, you know, they're bigger fans of doing what I would call cheap butterflies nearer term to take advantage of theta, as opposed to really, you know, minuscule prices for butterflies farther out for just the reason you just said, that there's so many places a stock can be with a lot more time than with 8 days to go, right? So that's kind of the concept there. Now, I'm not saying I necessarily agree to that. I'm sure there's a price and value for everything depending on what you're paying for something, right? If you're going to give me a butterfly in November of this year and I'm going to pay a nickel for it, I'm probably going to size up that one and buy it a lot. I'll take my chances for a nickel because my risk reward is pretty good. So,
Yep, definitely. And, I think we've only sort of talked about at the money butterflies here, but they can also be used as a sort of price targeting thing.
Yep.
The further away from the money that you get with a butterfly, the cheaper that's going to be relatively.
Yep.
Because the price really all comes down to the probability of the stock landing at that sort of point. So,
yeah, I'm just doing one out of the money, see what we get. So take a look at this one. To Mark's point, we'll end here for this session, but 320, 330, 340 with a 285 underline of Microsoft. Okay, so that's pretty far out of the money for that butterfly. I moved out in time a little bit, so I moved out to August. So let's take that into consideration. It's only a 12-cent midpoint. I'm gonna make it 10 cents, but that's it. Remember that October was about $1.50. Let's see what the same one is going to be in October. So the 320, 330, I think I did, and was it 340, something like that? See the difference? $1.50 versus 35 cents. Okay, so that's to Mark's point. If you have a price target, this is a great way to use a butterfly. It costs you very little to take advantage of your concept of where price could go, and getting short a little ball for a small price, right?
exactly, like a nice asymmetric trade if you do have that sort of price target, or
Yep.
I've even seen them used as hedges too.
Yep. Good. Okay, that's a good one. Mark, good to see you, bud.
Yeah, you too, Lex. See you next week.
Okay, talk to you.